Welcome to Advanced Accounting. In the first chapter, we're going to be looking at asset acquisitions. In chapters 2 through 6, we'll look at acquisitions again, but from the perspective of acquiring stock versus net assets. And we'll see the differences as we proceed. But let's jump right in and start chapter 1. You'll see that what I have on my screen right now is a template for exercise 1-2 from our textbook. The exercise itself is found on pages 38 and 39. The templates are available on the publisher's website, which can be accessed through the external link tab on Blackboard or through the syllabus link as well. These templates you'll find will save you a little bit of time in setup and potentially typing as you work the problems in the textbook. So on exercise 1-2, we're looking at Smith Company is being acquired by Radar on July 1st, and they give us information there regarding the exchange. The first thing we're going to look at is what is the price that was paid for the transaction. It tells us here that the exchange is happening by issuing 60,000 shares of its $5 par stock with a value of 20. So as you learned in intermediate, we record the acquisition or the transaction based on its fair market value at the date that it occurred. So we're going to take those 60,000 shares times the $20 fair market value to get our total price paid of $1.2 million. The second step then is to consider what did we acquire for that $1.2 million. Well, when we're acquiring, just like in intermediate again, we're concerned about recording what we acquired at fair market value. So you'll notice on the top of page 39, they give us fair market value for a number of items. So if a fair market value is not given, then you can assume that book value, for instance cash is not going to change, is the same as fair market value. So the cash came from the trial balance. The other items that I'm inputting are coming then from the appraisal values given on the top of page 39. So we see there land had a building or land had a value of 180. Buildings are 300. Equipment is 220. Current liabilities are at 80 and our bonds payable at 410. Then we want to see the total fair value that we have acquired, and if you haven't used this in Excel, you can use the AutoSum function to get the total value acquired of 560. We then compare the price that was paid, the 1.2 million, to what was acquired to determine any excess. And in this case, the excess is $640,000, meaning that there was some kind of underlying goodwill related to this acquisition. So the company that is doing the acquiring was willing to pay more than the net fair market value of its net assets because there was something that had additional value that was not something tangible. Once that comparison of price paid with net fair market value is determined, we can record the entry. With an asset acquisition, it's a one-time entry. So the company doing the acquiring simply records into their general ledger exactly what they've acquired in the purchase. So you'll see that I am just re-entering the asset items here that follow exactly the comparison that we did up above. Including the goodwill that we acquired of $640,000. Now if you remember back from intermediate again, see how much of this goes back to there, which is why intermediate is such an essential course for an accountant. Bonds can never be changed from their stated value, because that is a legal value, legal obligation. So in this case, our total value of the bonds that was given was $550, and that has to be recorded as the bonds payable because it's a legal obligation. So any difference with fair market value becomes a discount or a premium. So you'll see to get the net value here of 410, we used a discount. Okay, our other liabilities here were the current liabilities of 80. And what's missing then to make this entry balance is how the payment was made, in this case, for the acquisition. Now, in many cases, what we're going to deal with, the acquisition is done through paying cash. In this case, though, we saw that it was through a stock issuance. So when there's a stock issuance, we obviously have to record that just like you issue stock again from intermediate. So if you recall, there were 60,000 shares. Its par value is 5, so that's what goes in the common stock account itself. And the difference then is the paid in capital in excess. So now that we have our entry, we can just again use our auto sum feature to make sure that our entry balances, always a good idea, and we see that it does. So that takes care of the acquisition, the primary acquisition, one-time entry. It is now part of a single entity's general ledger and books, nothing else that has to happen. The only other thing we are going to record in this problem is the fact that there were some additional expenses that were incurred as this transaction happened. And those were things like legal fees, accountant fees, appraisal fees, etc., as well as the costs related to issuing the stock. Those acquisition costs, the legal, accountant, etc. kind of fees, are simply an expense and expensed as they're incurred. Here we're doing a summary entry. In real life, they'd probably just be recorded as expenses as the bills are paid. There were also costs associated with issuing the stock as the payment type, and those costs are an offset then to paid in capital, and that's the additional entry here. So that's our first example of doing a asset combination. We'll come back and look at one more with problem 1.4 to show how the price paid can alter the transaction, and then we'll move along in next module to doing combinations through a stock acquisition.